Okay, welcome everyone. Welcome to the Hurley Investments Market View commentary for, let's see, it says Monday the 19th of December. This will be our last one for the 2022 year. Don't forget, and I'm going to go ahead and I'm going to just type this in here right out of the gate. Don't forget, market is closed Monday after the holidays, meaning Sunday is Christmas, Sunday is New Year's, the Monday following will be the day off. A lot of people have asked me again, so why aren't you doing your webinars? And so it's for a couple different reasons. And ideally, my game plan, the reason why I do these every Monday night is really, I usually like to educate you something in that first 15, 20, 25 minutes. Try to find something about the stock market that I can point out that I can use for education purposes. I usually will give you some idea about what's happening in your portfolios. I really am doing this because it prepares you for the week and me for the week we have coming up. And obviously it's allowing you guys to ask questions. So if you attend these, you basically, whatever you would call me for, I'm already answering in some way, shape, or form in these webinars. The honest or more honest answer is I'm taking a bit of a break. My family's life has been turned upside down, and we have a kid that still doesn't get to sleep through the nights. And, you know, having a gracious wife, we're up throughout the night, and she does a majority of the work with Jared right now. And it's just a freaking miserable way to live. So the honest truth is big money is probably out by this Wednesday if they're not out already. Nothing happens between Christmas and New Year's. So the week of the 26th through the 30th, nothing really happens. Sunday is a day off. We have Monday the 2nd, which is a day off. And then things will start to pick back up. We might throw in a Thursday trade findings and adjustments just so we can touch base with you the first week of the year. But for all intents and purposes, as of today, not much should be happening, even though we do have a ton of economic reports coming up on this Friday. In fact, it's a pretty economic report week. So with all that said, Keith sent me a meme that I thought was rather interesting, and I tried to bring it up as a picture for you guys, and I'm going to adjust my screen here for you. The reality is I don't want to talk too much going into next year, but I think I'm going to prep you guys for it. I tried to spread it out so it doesn't look really good, and obviously the dark black line is 2022. The light black line, the light grayish or bluish or greenish, I don't even know what it is. I'm color deficient, right? The light line is 2008. And they're not an exact replica of each other. But something to keep in mind and something to think about was what we heard last week. And what we heard last week was pretty darn disconcerting, right? What we heard from Powell, and if you need to, go back and listen to what Key was saying. But what we heard from Powell was like 2026, we might hit 2% on inflation, right? And what we heard is we're still attacking inflation with rate hikes. And in all honesty, we heard no, we heard no real good news for the next 2 years. Which means, and I'm just going to say this in a roundabout way, stock picking and protection are going to be extremely important. And it's kind of funny because I did find an article, and I don't know, I kind of giggled at it a little bit, right? Where is it? Millionaire investors haven't been this bearish since 2008, which is kind of funny because it makes it sound like it's just this select few. When I think a lot of us, when you add all of our accounts together, are in that $1 million range, right? But millionaire investors, or 56% of million investors surveyed, expect the S&P to decline by 10% in 2023. Right? Nearly a third expects declines of 15% or more. And it's kind of one of those, duh. But what I thought was really exciting was just this little part right here, and I'm just going to highlight. Since millionaire investors own more than 85% of individually held stocks. So what does that tell you? When you hear that, hey, millionaire investors are holding individual stocks, what does that tell you? What is your thought process? Right? Millionaires holding, and I should say, individual stocks. What does that tell you? What does that equal? Smart money or dumb money? Okay, I agree with that. That they're using insider trading. Not necessarily. Okay, so I'm going to rephrase that, William. I'm going to rephrase that just a little bit, and you tell me if well, I'm going to say it your way. They aren't in funds, which is correct. But let me state it this way. They aren't in funds because they know how to work the numbers to find undervalued. I'm going to change that too. I'm going to say to find undervalued stocks. It's a Warren Buffett, right? Dumb money is in funds. Smart money is stock picking, and they always have. Warren Buffett doesn't run his money in funds. None of these hedge funds do it. Yes, I'm piggybacking on Buffett, so it's not like I'm doing something, something sensational on my own. I just know how to work the numbers. I will take the time to do the equations. I will have 3 weeks to go through all of the numbers like we did the middle of last January and still verify that there's that upside opportunity in these stocks with a decreasing earnings outlook and an increasing inflation outlook. So let's just say they work the numbers with a decreasing earnings outlook and an increasing inflationary environment. Thank you. Thank you, AutoCheck. And that's what I spend my time doing through tons of stocks as we're going through it. Abraham, I agree with you to a certain degree. And really, as I back check that article, what they were really saying is those with like $10 million or more, from what I saw, that was pulled, is a short answer. So a couple of you have asked, what does this all mean for next year, right? And I'm just going to make the comment. For the first half of the year, we could, and I'm going to go ahead and put this in here, very easily touch that 3,200 to 3,000 level. And I made the comment earlier this year, and we never hit it. We never hit that number this year. In fact, the lows that we did hit were about 10% higher, right? We hit 34.91. So we never hit that 3,200 number. But mathematically, we're actually lower than that. We're in that 3,000 to 3,200 range. And it's simple. I mean, the simple reasons why. Higher unemployment, higher interest rates. And I'm going to go ahead and I'm going to throw a couple unique things in there that should be pretty simple, right? Starting in January, we'll probably have a negative quarter in January, a negative quarter in June, just like this quarter. So starting in January, GDP will be negative, and we will enter another recession like 2022. It's not rocket science, it's simple numbers. I'm sorry the government hasn't acknowledged it. They're idiots. I mean, it is what it is, plain and simple. I'm going to throw a couple other out there ideas to think about. There are still labor shortages because people won't work. I know it's pretty obnoxious for me to say, right? But there are tons of job openings that most people will jump to, and it's almost like we're being trained to not work for the next stimulus package. It's scary. It really is scary that people aren't getting it. And I'm going to throw this out there as well. We've gone through a 40-year bond bliss market and a probably since 2009, right? And a 13-year historical, and it's only historic because it's lasted 13 years, bull market. But now we need to pay more attention to the history related to the mid 70s through 80s. That's kind of what we're looking at. And it's just a little bit of common sense. It truly is. I'm going to go ahead and I'm going to make this comment. Always there are higher than expected S&P 500 estimates given at the beginning of the year. And right now, I believe, boy, are we at 17 times earnings or 19? So I'm just going to say, not he, I'm going to say the last 13 years have skewed. I'm not sure I'm going to spell skewed right. I don't know how to spell skewed. There we go. Skewed the averages, but any 17 to 19 times earnings has been cheap. And historically average in a short period of time. If you go longer out in time, 13 times is historical average. It's unfortunate a lot of people have never dealt with higher interest rates. So we're going to have some overly optimistic beginning of the year estimates that will continue to go down. But it's kind of simple. Earnings usually are somewhere between 195 to 2,000 to 2,000. $195 to maybe as high as 235, 236. Those are the earnings on the S&P 500. You just multiply that out to where you think we're going to be. And if you take a look, I'm going to go through that whole range really quickly. If we do $195 times 15 times earnings, right? And don't let this scare you, but this is going to tell you the S&P should trade at 15 times earnings, could trade at 29.25. If we chose something like 200 times 15 times earnings, right? That's pretty easy because that gets you in that 3,000. That's an easy number to use. Something more realistic would probably be 205 times 16.5 earnings. And when we talk about the lows that we could be at and what seems to make more sense, that puts it right around 33.82. I'm going to call 3,200 because it's an even number. It falls somewhere between 200 times 15 times earnings to 205 times 16 times earnings, which is interesting because what will probably happen, the real earnings will probably be 19 times $190 of earnings for the S&P, and we'll still get that 16 multiple. And that's how I come up with, excuse me, not 16, 16.5 multiple. And when you run those numbers, 190 where companies aren't making as much as they expected because of inflation and so forth, times a multiple of the market is 16.5. That puts me at that 31,135. And that's where I would truly expect, if the bottom falls out, that's what we would be looking at right now. That's the number that we'd be looking at in this next 6-month period based on future earnings on the S&P 500, even though the S&P is trading at 38.17. So let me do a little simple math for you to where we're going to be. 38.17 minus 31.35 means a drop of 38.17, a drop of 682 points, or 682 divided by 38.17. So we do 682 divided by 38.17 equals a drop of 17.86% for a low next year. So to kind of brag a little bit about our last couple days, I know someone's going to say, Kevin, what are you going to do, right? So let's see how far I can go back. So Wednesday last week, right? Wednesday, S&P ended up being negative 0.61, and we were 0.34. Thursday, right? The big kicker. S&P was tanking like no tomorrow. Was down 2.49, and we were down negative 1.31. And then Friday, S&P 500. Thought I gave this to Keeve. Friday Friday, S&P was down negative 1.11. We were up 0.09. And then today, market was down a negative 0.90. And we were down. Got to get to it. We were down 0.54. So on Friday, we were able to change the delta to be down enough to make up more than the market was losing. And really, that's the goal for next year, is to over protect. But will someone please tell me, what does it mean if you're overprotected, if you're making more money on the way down than when the stocks go up? Can anyone tell me? Interesting question, right? Yeah. So actually, wow, 3 of you just came in, and all 3 of you are absolutely correct. Less profit, not make as much, less profit, not make as much, not be as high as the market. Perfect. You didn't say market, but I'm just going to put it in there. Not be as high, right? Otherwise, it sounds like we're talking about drugs. So that is correct. And the question will be, what can we add to make some more money up? And the short answer is, let me ask you guys, what could we add to make up the downward trend? What's going to buck the market? What do you think can buck the market if we hit a recession? They're usually, they have been 3, but it probably only will be 2 going into next year. What bucks the market in a downward trend? Commodities like food, puts, there you go. Consumer, boy, I can't spell. And I'm not gonna, what bucks those market trends? Sorry about that. There we go. Thank you, Maud. Consumer staples. Thank you, David. You guys both said it. Consumer staples. And there's probably one other one that no one's mentioned. It'll probably be oil. If we have China coming back offline and requiring that oil, there you go. So that's how we're taking a look at the market for the near future. Those are the things we see that we're worried about. Those are the things that we see that we're going to take our time to do a little bit extra on. Earnings dates is on Micron. It's the 21st after the market closes. And let me make sure I'm right. Yep. After the market closes, Micron. So we've had double the puts on Micron. We will not run double the puts through earnings. We will take the most expensive ones, the most profitable ones off, and roll the next ones to an at the money. Just for those of you that are in Micron. I think we've got double the puts on Ford, on Bank of America, on Micron. I think we've got a fourth one as well. I'm just brain farting it. Big picture, pretty interesting. The dogs of the Dow usually will make a good run going into next year, right? So the dogs of the Dow will usually run pretty good in the next year. Dogs of the Dow are Dow Inc., IBM, Verizon, Chevron, Walgreens, Merck, Amgen, 3M, Coca-Cola, Intel. Intel's not coming back anytime soon. 3M will probably not come back anytime soon. These were the dogs of the Dow. These are the ones that really have been awful. The dogs of the Dow I'm sorry. That was 2021. 2022, the dogs of the Dow look to be Verizon, Dow Inc. again, Intel again. Well, I just said that on the previous one, right? Walgreens, 3M, I said that. IBM, Chevron, Amgen, Cisco, JP Morgan Chase. So these are the dogs of the Dows for 2022. The previous ones were 2021 that were in 2022. But these are the ones that normally can have an 8 to a 15% increase the following year. Verizon, probably not going to do it. Intel, probably not going to do it. Dow, not going to do it. 3M will not do it. Chevron with oil going up could. Amgen, pharmaceuticals definitely could. Cisco, probably not. And JP Morgan Chase definitely could. Pretty interesting. So a couple of you asked a couple of questions here, so let's go through them. What about entertainment and some of those things like beverages and related types of businesses? Usually, Jim, those are consumer discretionary. And if we're in a recession and interest rates are going higher, kind of like this year, people aren't spending their money on the beverages or on entertainment. We're saving it to pay for our food and so forth. So that's why entertainment and beverages will probably not do well going into next year. Maud asked about CVX. Come on. So it kind of looks like maybe CVX didn't go up as much as some of the other ones, but that's a pretty good one. I don't know, Maud. That is a great question. Maybe I should do a better job of fact checking their dogs of the Dow. Well, it's just the big picture and how they look at things. That really is interesting. I don't have an answer for you, Maud. Market recap. Nothing here that I really thought except for home builders, actually. I found it interesting because a couple people asked, well, should I have already sold my house? I think going into next year, we're obviously going to be hit with some higher interest rates, which will make the sale of houses harder. But at the same time, it seems like we haven't caught up on the inventory of homes. And it looks like, if you were to ask me, we don't have the heyday that we used to have in supplies to build those homes. So just as a heads up, we might see home prices pretty much stay the same, or we might see them possibly even increase a little bit going into next year, which means that you still might have an opportunity to sell your home at a pretty decent clip. The question is, are you going to be able to find someone that can afford to buy your house? That'll be an interesting catch there. All right, today we dropped all the way down on the Dow. We are technically bearish again. Dow has crossed the median line, crossed on the Dow. If I was to use a 5 and a 20, a 15 and a 30, we would have a cross on the Dow Jones Industrial Average. Bounced off of support on the 50-day today, and we have the 200 right below it. It might meander there for a little bit. We might even get a dead cat bounce for a day or two before we continue to go lower, right? S&P 500. We also hit a bearish turn. And it just hit the 200-day, came right down, definitely bearish. We've passed through the 50-day, which I don't know if we're going to see a dead cat bounce on the S&P. And of course, our lovely NASDAQ composite, bearish yet again. Bearish yet again, and again, we don't see those lows. We're probably not going to take a break or a breather until we hit those lows of October. And I think I showed you a couple weeks ago, right? A couple weeks ago, I pointed out, hey, what usually happens, and I tried to show we had our ups, we had our downs. Our expectation was, hey, what usually happens, and I think it was the 1st of December, we usually go back and retest those lows. That is that herd mentality. I'm not a big fan of charting. And I think charting is like throwing a big net into the ocean to catch a variety of fish. There's truly no accuracy to bottoms, but to make a suggestion that we're going to go back and test those lows a couple weeks ago, again, Kevin's right. Kevin doesn't know crap. Kevin's right again, right? It's a general statement. It's a general understanding of how typical markets work. And it would not surprise me if we're testing those lows of October, the beginning of next year. It would surprise me if we were to lose, 230 points, 320 points, 325 points in the next couple weeks, next week and a half, 2 weeks. I would not expect that. But I do think we will go down and test those the beginning of January. We will go into oversold territory on the S&P, and that is nothing more than just herd mentality. December, I said we'd probably lose 4%. Going back up to the S&P, we started December, 4,070-ish, maybe 4,080-ish. And we're down to 38, so that's about 5%. I might need to adjust that. We could probably see, 9% seem to be those down months. June, September. We could see between 9 and 10% in December. And yes, if you read my email, it seems like James Powell has killed the Christmas rally. The Christmas rally is dead. I'm not sure about Nike. Let me see if Nike reports. I thought that was rather unusual, but let me see if Nike reports. Next earnings are on the 20th. So Nike has earnings on the 20th. BlackBerry, General Mills, Rite Aid and Micron on Wednesday, CarMax and Paychex on Thursday. Not much on Friday, not much on Monday. Nike will be an interesting one to look at. If Nike misses their earnings, all retail is going to take a hit. So if you're trading something that's retail that does not have protection on, you might want to really consider getting that protected as quickly as possible. All right. Looking to trade, we do have puts. We have SPY puts on. We are looking relatively closely to adding another set of SPY puts on. I just wanted to verify today the break of the 50-day. Keith and I really talked about it on Friday, and of course, in hindsight, we should have put more SPY protection on Friday when it finished below the S&P 500. It's just weird things happen over the weekend. Look for us to add some more SPY puts and accounts to make up more of that downward movement on your portfolios so that we can be profitable on those down days. I just put some articles in here that I thought were interesting. Goldman and Citi love these two beaten down tech stocks. One of them is Amazon, that's lost 50% of its value, all of its gains from COVID years. Really toast, right? Which is rather unique because a lot of people were using Amazon, but it kind of, what it really goes back down to is when it did its stock split, it diluted its shares, and people don't want to hold that many shares of Amazon. So here's an example of a stock split that killed the stock. It's hosed. Meta, another one, down 65% in 2022. It actually is closer to like 72%. But a reason why it might take a little while longer is because, one, the first thing to go in a recession, and this is more of a telegraphed recession, is their advertising, right? And the second one is it was so poorly run with the metaverse that they need to stop spending as much money on it and just let the metaverse make some money, is the short answer. A lot of people talk about the Apple privacy issues. Their numbers didn't show it. They still sold a crap ton. Their margins came down a little bit, but it was nothing to be worried about. The bigger concern over Apple, those are truly not headwinds. The biggest concern is what Zuckerberg is doing and blowing cash like it grows on trees, upwards to $30 billion over the last 3 years. I found this one really interesting. Once again, 2022 didn't go as expected for bank investors, but somehow that's going to change in 2023. Again, banks, anytime you increase that interest rate, it increases the margin and the spread that they can make more money off of you. It also increases the interest on credit cards and on interest that they make off of you. I would have thought banks would have done much better, but their profits were lagging due to the higher interest rates, and a lot of people locked in some lower loans, which just lower loan rates, which means a lot of their capital they have available to make money on is tied up in lower earning or lower fixed income earnings than what current interest rates are saying. So that's the dichotomy right now. The analysts are like, 5.5% interest. They got to make that. Well, no, you dummies. They locked in rates, and until they clear that off their books, have the federal government, Fannie and Freddie Mae, buy those off of them. They're stuck with capital that's invested at a lower rate of return. I did like the bull case, and I do agree that you can see some bank stops pop 50%. Really, all that does is get them back to their highs, but do pay attention to them. It is rather interesting what they say. I found this interesting. It's kind of hidden underneath the background. This is an older article that was linked to a newer article that's not quite released. But in September, none of us talked about the US and China are one step closer to preventing Alibaba from delisting. We didn't talk about what the US was doing to allow stocks in China to continue to be listed on our stock exchange. All we talked about was they're not being honest, they're not this, they're not that, and it sounded like we were going to give them all the boot. We have another article coming out probably the beginning of next year, which will be more adequate on explaining exactly how we're going to keep those stocks from delisting. This was sent to me from someone in our someone that I love and respect. Let me just put it this way. Gun shops and customers claim credit card firms restrict firearm purchases. They primarily state Visa, MasterCard, and American Express. I have not noticed it yet, but I primarily use Discover, but I did find it interesting that supposedly, and they've got the pictures on here, supposedly we're seeing some of these financial industries restrict purchases of firearms. Some are going to say they infringe on Fourth Amendment rights, blah, 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 blah. The fact of the matter is, just pay attention who you use. And I found another interesting article. Beware of these stocks. I don't see a rough year ahead for these companies. And I don't recognize a lot of them, but Franklin Resources, Consolidated Edison, which is utilities, Franklin Resources was finance, T. Rowe Price Group, which is finance and accounting, Campbell Soup, consumer non-cyclicals, another finance, Principal Finance Group, General Mills, which is a consumer non-cyclicals, which again, I'm going to call them consumer staples to a certain degree. Pinnacle West is utilities, and Vesco is finance. Kimberly-Clark is consumer staples. Clorox consumer staples. Genuine Parts consumer staples. Industrials, which you wouldn't expect to do good in a recessionary year. Market Access, which is financial. Universal Healthcare Services, which is healthcare. Medler Toledo, I've not heard of them, which is healthcare. J.M. Smucker, again, consumer staples. Quest Diagnostics, which is healthcare. Another industrial for Xylem. McCormick and Company Incorporated, consumer staples. Etsy, consumer staples. I found it really interesting that if we're expecting a downside year, and people have asked me, really, Kevin, you have to stock pick? most people would think finances and consumer staples would do really, really well. As you go through this, a little shocking that they don't look that well. And we're also going to be looking at it in regards to just putting them into a basket's not going to work either. Apparently so. If you go through and you work on some of these numbers, you'll truly see we're looking for some trouble next year. And then I have my millionaire investors haven't been this bearish since 2008. Interesting article, but I do feel I might need to work some of those numbers. Any questions for me as we close out our year? Yes, in fact, Russ, if it's okay, I will give you a call tomorrow. Text me an email and give me a time that works for you. So yes, so Kevin, how can you describe Boeing? Boeing has already been down and recently had a $43 billion order with a 9.56 year backlog. So if you want to explain Boeing, it's already been hit. It's already taken the losses. It has a ton of opportunity in it that it should have had 2 or 3 years back. It was held under due to it's been held back due to its poor management on, I don't even disagree. It's been held back by the government, right? Well, Kevin, their planes killed a bunch of people. But if they did the training and read English, maybe not. Maybe it would have been easier to turn off the autopilot and the flaps on the wings for some of the things. I'm not a pilot, so I don't know. It's almost like Boeing has already taken its pain, is what I'm going to tell you there. And someone asked before on Ford, what were the other two questions? Ford and Disney, right? So those are pretty easy to talk about right now. Disney down because Avatar only, can't spell, only made $240-ish million worldwide and 134 domestically. So again, this is kind of one of those that they're looking at a $400 million run, only came in at 240-ish million. And so it's down. Ford, pre-recessionary fears. I'm only saying that because truck orders are strong. Pre-orders for the electric, I'm just going to say it this way, not a real truck. And I'm only saying it because if you pull 3,500 pounds, it only has 68 miles, right? Are strong. There's still a bunch of pre-orders for people that want to fart around in a truck that's an electric truck, but not be able to do anything a truck can do. And what was I going to say though? Pre-ordering fears because truck orders are strong. Pre-orders on trucks, on real trucks are strong. But they've raised the electric truck price by 40%, which will obviously hurt orders moving into the future. You know, the good news is we've got, pretty sure we got a couple sets of protection on Ford. So we've been making more on the way down the last week than the stock has lost. So there was the comment to that one. Mod, as of right now, there's nothing that says that they have a higher repossession of cars because they do finance their trucks and their cars in general, excuse me, their automobiles. So with all due respect, I don't see the defaults. And if used car prices have collapsed and they're down to nothing, it's really junk. I think most people are still looking to replace those cars. I mean, I've got a Ford F-150, 320,000 miles on it. Let my kid take it this weekend to go skiing, came back without the passenger side mirror on the outside, you know. Had to dodge a truck that was coming at me, and I was on the side of the road, and a branch knocked off the mirror, and, you know, we just can't kill. I kind of sat there and said, why didn't you let the Honda or the other truck, it was the Honda Pilot, right? Why didn't you let that Honda Pilot just hit the car, total it so we can get some money for it, and put it into my new F-150 or F-250 or F-350 that I really can't afford and shouldn't be spending money on right now. But I don't know. If the used car prices have collapsed and they're dirt cheap, I still don't see the numbers that said there's a high number of used cars right now. And I don't have an answer for it. In fact, Jim has actually just typed in Ford has significant recall issues also. I haven't seen that. I know they are in a couple 100,000, but comparatively speaking to all the other cars, they're pretty minute. So I haven't seen the recall issues being for something that is deadly or dangerous, but that obviously doesn't mean that it's not there. So Jim might have some more information than we do there. Good questions. Are there any other questions? I knew someone would say that. Apple price is collapsing. So again, I don't know if I would go so far as to say Apple prices are collapsing. And I don't think Apple will go out of business. They're at 132, broken that 134 level that was support. We're already retesting the lows. And again, what does this relate to, or what have I seen from Apple that's been the worry, right? It's China again, right? I don't see, I can't get that T. I need to get a new computer where the T works better. I don't see pricing collapsing. But it obviously is down. I'm saying that, right? What were the highs of Apple? 188? So I might be a little full of it. Let me see. 182.94, beginning of the year. 182.94. So we have Apple that is down from the highs in January of last year. 182.94 minus 132.37 where it closed today. Down $50 on 182.94. Yeah, I mean, we are down 27.4% from the highs being January of 2022 being actually I don't know when that was. They all just say so. The highs of the year were 182.94, down $50. So $50 and 182 again. I just said 27.42%. It's China. I don't see pricing collapsing, but worries in China and COVID. So that's, I mean, that's Apple right there. Am I worried about China? I'm just going to say not so much because I've seen Baba and Baidu strengthening recently. And I mean, I guess we've gone through COVID. I don't want to get into conspiracy theories, but yes, they'll probably have a higher death rate than the United States, and they will probably it will probably be seen as worse over there than it was here. But when you see Baidu and Baba strengthening and gaining in their numbers for their earnings, it didn't bring anything to my attention that changes my perception of China. David, let me know if that answers your question. If not, go ahead and ask it another way. All right, anybody else here? I'm gonna take a look. Rich, Russ, Maud, Kohler, Bosserman, Bill, Dave, David, Mary, William. Any other questions you guys have for me that I can get answered for you before we take a break for a bit? And Russ, just send me an email or a time or text me, either one that works for you. Are you going to change your core holding? So that's also kind of interesting, right? Are you going to change your core holdings? And so probably not, because I keep working my numbers throughout the year, but I may add to them for a, how would I say it, for a sector that can buck the market. And I think I kind of said that already, so hopefully that'll make a little bit better sense. I work my numbers. I mean, there's very few that I just forget or bail on, because we're working our numbers and checking everything to make sure that we're on the same page, that we haven't missed anything. And the numbers and the trends and the thought processes are still there. Nothing's really changed. But do we need to look at something else, especially if we have a bunch of stocks that have been hit all year long? Maybe, but those that are hit all year long, or now that are going on 2 years, have that pretty big upside opportunity. So it's just something to keep in place. Dave and William, Merry Christmas to you as well. Maud, Merry Christmas to you. Bill Brander, Merry Christmas and Happy New Year to you. Abraham, Merry Christmas to you. I appreciate it. Thank you, Jim. I will do the best I can to have a blessed Christmas. David W., Merry Christmas to you. Mary, thank you very much. Blessings for my son. I appreciate that. All we're going through is our new normal is different than we ever expected. And he's still alive, and there still is some good opportunity to get better. We're just now, our new normals, our improvements are a monthly basis and judgments versus a weekly or a daily. He's improving on a monthly. You can see the improvements. On weekly or daily, you just don't see the improvements. They're just not there. So, Mary, thank you. All right, guys, enjoy your new year. I am available if we need to talk between now and then. Give me a call, and I look forward to seeing you guys at the beginning of next year. Bye-bye.